episode 74 of Top of Mind with Consilio Wealth. It's been a little bit of a vacation for us here on the pod, but we're back today to talk a little bit more about what's going on in the news. Back by popular demand. I will take full credit for taking a little hiatus here, but we've had a number of you reach out and say, where's the next pod? I like listening to it. So here we are. We're going to keep it going.
Yeah, thank you for everyone who's asking where we've been. I was honest, it was Chris's fault, but
It's my fault.
thank you everyone who's been, where's the next episode? Didn't think we'd ever get to this point, but we got people asking, which is pretty cool.
So on today's episode, we're going to be talking about the jobs market. You all have probably seen in the news that the jobs market has kind of collapsed a little bit. Unemployment's rising a bit. Trump's firing the BLS commissioner. And so there's just a lot going on right now in jobs. We thought we'd unpack that. Travel and the consumer. Travel seems to be growing but slowing. And I don't know if we'll get there, but the housing market is completely frozen. And then finally, we wanted to talk about alternatives in 401ks. There was some regulation that was passed recently that said 401k plans can hold alternative investments, or more specifically, private investments, things like private credit, private real estate, even private equity.
But also cryptocurrency too.
And also cryptocurrency, yeah, which could be another tailwind for crypto. So we're going to talk about all that stuff today and maybe some more. So Hal, over to you. Let's start with jobs. Get that one out of the way.
Yeah,
What's going on?
Today, as of this recording, September 5th, 9:25 in the morning Pacific, the jobs number post this headline. So Chris mentioned the BLS commissioner was fired. We have a Trump loyalist being nominated, but has not yet been confirmed to take over the BLS. So payrolls rose 22,000 in August versus an expected 34,000 jobs being added. The underperformance continues, right? So we set an expectation, and the reality either meets or exceeds that, or it goes below that. And we've had a string of months where that reality of jobs has come in a lot lower than expected. And the reason for the firing, there were revisions to the May and April data, which is par for the course. So the revisions are needed because the BLS data is voluntary, and the companies that are participating send in their jobs data later than when the report goes out. So that's why you have to go back several months to redo the numbers, because these surveys aren't coming in on time. So Trump was upset with the revisions because they were pretty steep revisions, but they were not out of line with what the historical pattern has been. Generally, when revisions happen, whether to the up or downside, there tends to be momentum with it, right? Downward revisions tend to beget other downward revisions, because in a tough job market, it doesn't turn around like a speedboat, right? It takes more like a cruise ship.
Mm-hmm.
Turnarounds and downturns take quite a bit to turn, but the history of the data has been consistent for quite a few decades. So go back to more recent, though, downward revisions are common, just as they are for upward revisions. But the Trump administration wants to show that the economy is on better footing than the jobs number suggests. I don't know where data meets reality, right? So what they're obviously implying here is trying to get more rosy data picture, right? Set up a environment where jobs are more plentiful, at least on paper. But I think you could see where that becomes an issue, right? Because if you're actually looking for a job, you're like thinking, hey, jobs are plentiful, I'm going to be able to find a job. And you're applying for months on end, years on end, and despite the jobs number, getting an actual paying job is another thing, right? There's a reality component to this.
Yeah, I mean, I think what the firing was meant to do was saying this data isn't accurate enough. I think that's what he was after there. So, because it was like the size of the revision is like, well, somebody's not doing their job right, therefore you're fired. And then, maybe that's accurate, maybe that's not. But I think that was the basis for it. And, yes, I agree with you. Remains to be seen on who goes in there, and then, will there be trust in that individual or that organization?
Correct.
Now with a a person placed by the president. But I do think the original intent of firing was because the numbers swung so far, which is not out of line with history, by the way. They've done this happened in the past.
Yeah.
But I think that's what the goal was there.
Yeah, so today, even with another disappointing jobs number,
Yeah.
Dennis Hassett is a White House advisor saying the disappointing jobs report is expected to revise up. How do you know that, right? Howard Lutnick says, these are all quotes from today. Howard Lutnick says, BLS reveals figures will be more accurate going forward. But again, what are you going to do? You're going to get these surveys in on a more opportune time or more timely manner. I don't know. I think the market is going to be watching the BLS reports like a hawk because we've had similar data maneuvering moments. Argentina did it back in 2007. It's a very short-lived win for whoever is in charge of that data. If you're trying to smooth for effect or trying to put it out to where it looks better than it really is.
Should we talk about the Fed real quick? I think this is kind of related.
Yeah, and another point of contention since we've talked last was Fed board member Cook is being accused of mortgage fraud, which was put up by Jim Polte, who is part of the housing and urban development wing of the administration. This is important because they're looking to replace enough Fed board members to start, one, get more aggressive with rate cuts. To be clear, the battle with Jerome Powell and Trump has been pretty public. Yeah. But everyone knows that the Fed, when they raise or lower rates, that only impacts the overnight rate. Typically, it hits like SOFR rate. I don't know what SOFR stands for anymore. That's the lending rate for like margin loans, for a lot of auto
credit.
Loans. Yeah, for private credit, which we'll get to, for savings rates, right? So everyone's enjoying 4.0% in their high yield savings. So if the Fed lowers rates, that would go down. But that's pretty much all the rates that the Fed has direct control over. The reason why why the administration wants to replace more board members is they have control over what's called quantitative easing or quantitative tightening. In 2020, the Fed opened up a bond buying program, meaning they were jumping in and buying mortgage-backed bonds and 10-year treasuries to bring down interest rates. How did we get 2.5% mortgage rates, or how did we get 3% mortgage rates in 2020 and 2021? Well, it was the Fed. They felt when we shut down everything during COVID, they felt that they needed to keep the economy afloat by pushing rates down in the probably most direct way possible by bringing down mortgage rates. And everyone refinanced, everyone kept spending, right? And the spending that we're feeling today led to inflation, led to all these things. What the administration is trying to do is kind of a repeat of that, probably not in the extreme, but have more control over the 10-year treasury rate, which is market driven, right? That's really supply and demand. So if more people want to buy the 10-year treasury, our interest rate on the 10-year goes down. And less people want to buy, like less demand, the interest rate goes up to try to spur more demand. Mm-hmm. So what the Fed has been doing in the last year and a half, last 2 years, was a runoff, meaning letting some of those bonds expire normally or selling them back to the open market. Again, no coincidence that our mortgage rates have shot up from 3% to nearly 7% at times. That's what's been happening. So quantitative easing was kind of a new tool in the toolbox for the Fed. And that was a result of the housing crisis, right? And that was used again in 2020. So here, what's the emergency?
The emergency is the housing market is frozen and the job market is frozen.
That could be it. But then it also shifts debt from the U.S. to the Federal Reserve, which does not have a debt limit.
Oh, I see what you're saying.
Yeah. So the debt, that's another thing. again, we're not saying we're for or against this, but there's an interest in the Trump administration to push those rates down. Lower rates can potentially unlock the mortgage market or the housing market, which has been stubbornly frozen, right? And I think sellers are unwilling to lower the prices enough to induce buyers paying 6.5% 30-year fix, right? The monthly payment is out of reach for a lot of people. And I think this could help, but again, what are the side effects of it, right? If you unlock the mortgage market so abruptly, I don't know what kind of things are we looking at that we're just not seeing right now. Those are the types of questions you should be asking, but no one has the answers. Everyone thought the answer for raising mortgage rates with lower prices, that hasn't happened, right? Houses got more restricted in supply, therefore they got more expensive.
Looking up a bunch of stuff here while you're talking. I think, well, let me pose a question, because I've got a bunch of stuff on my screen here. What is your, related to all this, what's your prediction to what the Fed does here they meet next week, week after next week, I believe.
Yeah, in 2 weeks.
2 weeks. What do they do regarding interest rates? And possibly more importantly, what do they signal for the rest of the year?
Yeah.
What do you think they do?
So looking at the timeline, this is probably why the Trump administration is so aggressive. One, I think they realize that they're gonna see a flipping of seats in the House at least in 2026. So there's one expiration date that they need to look forward to. Another one is Jay Powell ends his tenure in May 2026. So Jay Powell has been trying to get this inflation beast tamed without the corresponding recession that we've historically needed to tame inflation. Hence the term soft landing. So in 2 weeks they're gonna cut rates by 0.25%. At least the market thinks there's a 97% probability of that happening, which is pretty much a done deal.
Yep.
It'll be a 0.25% cut. So those high yield savings will pay 4.0 today. They'll start paying 3.75. And what the Fed will signal is we have at least one more cut this year, in addition to the one in 2 weeks, total of 2 cuts. And then we plan another 2 or 3 cuts next year, early next year. All to establish essentially what they call a neutral rate for the next incoming Fed chair, which will be Trump nominated. And they'll likely try to ram through that nomination before November as well, because again, they're going to probably look for someone who is more friendly to the Trump team's goals.
Okay, so you're saying they're going to cut here in 2 weeks, and they're going to cut one more time at the end of the year, and then signal just continued cuts, of course, being data dependent.
That's what's being priced in now. So the market will respond positively if there's going to be explicit forecast of 3 cuts total.
Yeah.
So right now we're sitting on 2.
Yep.
If the Fed signals we're going to be more aggressive in cutting, look for a stock market rally there.
So I agree with you. Fed's going to cut here in 2 weeks. I think that they signal. So they started to do this when they started to cut rates so long ago. I don't even remember when they started doing that. And then they paused, right? It was so long ago, I don't even remember. But they said, we're cutting now, and they came out with this jumbo cut, which is 50 basis points, 0.5% versus 25 or 0.25%. And then they said, we're going to cut, it was like 2 or 3 more times. Like they kind of signaled that. And then they went about face on that at their next meeting. And they said, hold up, we're not going to do that due to data and whatnot. And then this whole thing became really political. So I think that they go a step further, because I think that based on the data, based on housing being frozen, the job market being frozen, employment coming up, I think that they're going to signal a ramp off of cuts versus say, we're going to cut today and we're going to be data dependent. Stay tuned.
Yeah. And I think the market will be super appreciative of that fact.
Well, look at this. So I'm looking up Rocket companies. So Rocket is Rocket Mortgage. They just bought Redfin. They bought somebody else recently. So they're now a $42 billion company that is well positioned for as rates fall to start selling mortgages, right? This is a company that's up 100% almost since April. right? So they were totally beaten down just with, higher rates, not selling mortgages and whatnot. I think they've made some strategic acquisitions in the last handful of 6 months or whatever as they've closed on some of these. And then ultimately now they're up. Now they're up not because mortgage demand is significantly up. It's priced in, right? It's priced in that rates will fall.
It's pricing ahead of the Fed, yeah.
It's pricing ahead of the Fed. And I think that's important to see for investors that are out there listening to this, is like, it would be difficult to say like, okay, I'm going to buy now because rates are going to fall. The market's usually ahead of you. Today, Rocket Companies is up 4%. So on the heels of this job report, that is not great. Rocket's up 4%. DR Horton,
Correct.
huge builder, $54 billion builder in the US, which is also up 50% since June or so. Up 3% today. Toll Brothers, $14 billion builder, up also 50% since April, up 1.5% today. Another builder, up 2% today. And you guessed it, up 50% since April. And the 10-year Treasury came down a little bit. It's coming down a little bit.
Yep.
The trend is down.
Pulte, the head of HUD, is the grandson of the Pulte Homes creator.
Great.
And I believe he still has a relatively large stake in the family business there.
Pulte? Thank you. Learn something every day here.
Well, when you just read something and it's pronounced like segue or seg.
Segue is the weirdest word out there.
I think I know what you mean.
In fact,
go ahead.
Just real quick, I was driving down the freeway, I guess yesterday or the day before, and there was a truck, and it was like a construction truck or something like that, and it was like Segway construction. But it took me I had to glance at it a few times because it's Segui.
Segui. Yeah.
Segui, is that the guy's last name? It's like, oh no, it's Segway.
Segway,
okay.
Yeah.
So Segway.
Well, the inventor of the Segway scooters spelled it right. Segway. That's how you should spell Segway. Yeah.
Far better.
Spell it the way it sounds.
Yeah, exactly. Well, welcome to not the English language.
Yeah, but also jumping back to jobs number and rates.
Stay on track.
Yeah, the Trump administration is trying to have its cake and eat it too. Because, one, the weak jobs number is opening the door for lower rates. That's just very clear cut. So if you're manipulating the numbers and pushing the jobs data up, there's no justification to cut rates because the job front is strong. That's why the accuracy of data is important, especially from a government agency like the BLS. So what the market's going to do is just shift their focus from the BLS numbers, because they know it's rigged, to ADP numbers, which is a private company representing jobs. So,
good call. That's a good call out.
Again, I think we're here for information as accurate as possible. Again, revisions are a normal function of this, and I think to make yourself look good on paper has other side effects that are in direct conflict with your other goals, i.e., lower rates. Right? If you have a robust jobs number, rates shouldn't go lower. It's pretty simple. So if we're trying to get lower rates, yes, I think today represents a poor jobs number, but it opens up the door more for lower rates.
I agree with you, and that's why he hasn't cut, really. In his defense, the economy has remained ridiculously strong, right? We still haven't had a recession, even including 2022. How is that even possible with all the rates going up? 20 out of 10 economists said
2.9%.
Not bad, right? Yeah. And it's like, okay, yes, it seems like we are starting to hit a wall or fall off a cliff or whatever you want to say in terms of jobs report, and definitely housing is stuck. I actually saw ADP in this article. I wanted to see what they said. Let's see if I could find it real quick, because it was quoted. I think you make an interesting point. ADP. All right, ADP. Friday's report follows data out Thursday from private payroll provider ADP showing 54,000 private sector jobs were created last month. Data from the Labor Department showed initial filings for unemployment tallied 237,000 last week, which is the most since June. So that's interesting. ADP showed 54,000 were created last month. But this report was way less than that, right? This report was 22.
22. Again, ADP takes like the payroll data that they actually process for, because they have insights on all those businesses. They can make a pretty instant forecast of that, versus the BLS is all survey and volunteer response. So if a business is busy with something else other than reporting their jobs number, I bet a business is going to focus on their core business versus filling out a government form that is entirely voluntary, right? They'll get to it when they get to it.
I still want to get that consumer sentiment phone call someday, because I hear it's like literally a phone call and they just are like, are you feeling good or bad or indifferent? And they ask you like 3 or 4 things and they hang up, and it's like, I'd love to answer that. So
yeah, we were saying consumer sentiment feels off, especially in 2023 when jobs were so plentiful. We just mathematically just couldn't get better than that. Mm-hmm. And the fact that people still felt crummy was probably a bad divergence, because the real data, like in real life, right, finding a job is empirically harder than it is now than it was in 22, 23, even 24. So when you filled out the consumer confidence survey, I said you should have got fired. I stand by that. I think you're a crummy survey taker.
We got to keep rolling here because we are totally going to run out of time. And
all right,
that's because I'm here. See, I'm here to keep us off schedule and talk about stuff that's like super interesting, and you're here to keep us on schedule.
Travel in the U.S., canary in the coal mine, right? Is it an issue? I think Las Vegas is probably the most notable. Also New York. The visitor numbers are dropping off a cliff. This is also adjusting for seasonality, right? Just generally, summer months are the worst months for Las Vegas because it's the desert and you don't want to be out in 130-degree heat. But even adjusting for that, Vegas is down. Visitors 11.3% year over year for June, and that number has crept up to 15% year over year for July. The official August numbers haven't come in, but I'm going to venture to guess that the trend is continuing. New York saw a drop of 17% year over year, about $4 billion of foreign spending not being spent in New York. Los Angeles, 25% drop year over year. And then Orlando, up nearly 6%. Miami, up 3.7%. Chicago, up 11.5% for various reasons.
What are those reasons?
I don't know. What would be Chicago's? What would be Chicago's?
I don't know. I don't know Chicago. I think Orlando and Miami. So I know it's a big Canadian destination, and so I don't believe that the numbers. Initially it was thought like, the kind of the sell U.S. trade, right? I don't think we've actually seen that in the data, and like we spent a little bit of time down in Florida, down in sort of like the Tampa area almost. Tons of Canadian license plates, like people are driving all the way down there. So. Maybe that's it.
Well, again, we track this Big Brother a little bit. This is from Bloomberg. Cross-border auto travel by Canadians drops 37% in July. I don't know if this is going to be long-lasting because, yes, the administration has increased visa costs from, I believe, $100 a visit to $350 per visit. So you got a family of 4. That's a $1,400 increase in visa costs, right? So yeah, it's a lot. So that's one friction. The other part is Las Vegas has been, I don't know how to say it, but like nickel and diming, overcharging in a lot of different places, right? You'll see a room rate go for $50 a night, but then you book it, it's like $250 after all the fees and
I feel like we needed to go do some research on this because I've seen this all. Yeah, I've seen this all over Instagram. And it's like, I checked out at the 7-Eleven and it was $28 for a water and a pack of gum, and I'm like, really?
I see that a lot too.
I see that.
Who charges $28 for water?
We got it. I think we need to go down there. Quick little business trip, I think, and we need to go check out, like, go buy some water at a gas station. I hear that there aren't free drinks anymore. Yeah, when you're sitting at the tables and whatnot. I mean, this is why people go. But I just can't I can't fathom that to be. I don't know. It's just all over the news that like Vegas is struggling and they're nickel and diming people. I'm like, okay, sure, but really, like $40 for a water and or let's go to the Chipotle down there and then we can really complain. I don't know. I just think it's crazy.
There's a restaurant, Ami Gabi, dinner menu, cheeseburger and fries now cost $31 plus tax and tip, compared to $17 4 years ago. But I think we have a chart from Sherwood News that peak Vegas was actually 2016, 3.6 million visitors. Now it's dropped to 3.3, which is, again, not a huge drop, but again, notable for total number of visitors, right? A lot of people are saying that nickel and diming, in terms of resorts, their tourism tax pays for stadiums, right? So it's like a $50 a night fee. So if they have an extended drop in visitors, right, they do have quite a bit of liabilities that they need to pay on the back of that tax revenue. So to be fair, Clark County does have about 2 years worth of runway. So if they get zero revenue from this, they can still pay their debt obligation. But eventually that will have to fall on the general obligation tax base, because if you're not generating that tax revenue from tourism, right, because even if it's down not 100%, significant amount enough, you're going to run out of runway to pay those debt obligations, right? So they paid for public money. The NFL Raiders Stadium, Allegiant Stadium, is $1.18 billion in liabilities, and they're also currently building the Oakland A's Stadium, which will soon be the Las Vegas A's, $120 billion on top of that. They also still have obligations for the hockey arena renovation, which is partially publicly funded as well. So that's a lot of revenue that they're potentially not getting. This drop, this is a double-digit drop year over year. If this persists, that would have to fall back on the residents, right? Because if you don't have enough tourists, you as a resident of Las Vegas, Clark County, are going to have to pay for that.
Mm-hmm.
Because this bonds don't go away, right? You got to pay the thing back. You got to pay the interest.
I want to move us into alternatives in 401ks because we've got a few minutes left here. But if anybody out there has been to Vegas recently, send us a message. I'd love to know. Send
pictures of receipts.
Yeah. Like I got to see it with my own eyes. And so my wife and I just had a baby a couple months ago, so I probably will not be going to Vegas as much as I'd like to go to Vegas and check it out for just a quick trip. But maybe next year, maybe 2026. All right, let's move on to alternatives in 401ks. This hit the news a couple of times. Hit the news kind of pre and then signed. Executive order that Trump signed that said 401k plans can now allocate to private investments such as private real estate, private credit, private equity, and crypto. And so on the heels of that, now you've got BlackRock already talking about we're going to add somewhere between 5 and 20% allocations to private investments into our target date funds. You've got Vanguard talking about doing the same. So they're working with Blackstone, who's the largest provider of alternative investments, and their other fund group, Wellington. Vanguard has a lot of funds that are sub-managed by Wellington. So same thing, aiming to offer exposure to private markets within that single fund structure. And Empower, I think, was one of the first to the news. I don't know if anybody has a 401k at Empower out there. They're actually pretty big. They're doing the same. I find it interesting that a lot of this seems to be embedded into target date funds and not as a standalone. Maybe that's just because
they can control that.
Yeah. It's like I actually think it's interesting that I don't know the data, but a lot of people buy target date funds, obviously, and you're going to be forced to buy this stuff, like it or not, versus have it as a separate fund. I think that's interesting, but what's your take? And let's just talk about this for a couple minutes.
Real quick, pluses and minuses. I think there's a long history of private investments that have benefited endowments and sovereign wealth funds, right? That's been a big part of their investment portfolio, whether it's democratized or, some cynics will say these retail investors, these 401k savers are liquidity, right? These private investments don't have a huge market. If I'm Harvard and I need to offload 10% of my private holdings, I got to call Stanford, right?
Yeah.
I got to call I got to call Norway. And if they're not in the market to buy more, who am I going to sell it to? Let's say it's worth $100 million, but if someone's only willing to pay $50 million, what's the investment really worth? So the private space, I can tell you, for Chris and I, our personal experience, it's a big market and there are a lot of new players in there. And the amount of research you have to do is insane. And it's not a lot available publicly. So you have to make a lot of assumptions with this stuff. The fact that it's folded into target date funds, depending on the percentage, because we do believe that having a small percentage outside of the stock market is actually a pretty good way to diversify your portfolio, like real estate, right? Or other things that are not stock. I think that's good. So if it's 20%, might be a little high for us, but we think that depending on the private fund, full disclosure, we do business with Blackstone, but really depends on how much you're plugging into these target date funds, which, if it's excessive, that could be an issue. If it's too little, we've seen it not do too much, but maybe that's the way to go, err on the side of caution. The fact that it's opened up, I don't know. If it's selectable, I would worry about a DIY person saying, hey, I want 50% of this stuff without really realizing what they're buying into versus having a target date. Vanguard, BlackRock, and Power all have investment professionals working on the saver's behalf. So I generally feel that there's a layer there where they're looking out for the allocation, but let's say you have the S&P fund and right below it is the private. I don't know. Is a DIY person going to select the obscene amount percentage-wise in the private fund without really knowing what it is? That's probably the biggest issue I have.
What was the company that hit the news recently? Was it Yield Street? Fundrise? That blew up? You and I were talking about this.
Yeah, I can't remember.
So it was one of these. It was one of these real estate companies. So a handful of years ago, these companies became popular. It was like Yield Street, Crowd Street. I think it was like My Rich Uncle. These other ones, and it was all about trying to
pool the investments into
pool investments and get these otherwise rich people investments down to everyone else. And so you could go in with maybe a $5,000 minimum, $25,000 minimum, right? When you otherwise would need a lot more money in order to get into a real estate investment. Well, one of these companies was just in the news because like a lot of their investments blew up. And the point of this is like, well, do you really think that you're getting a good investment if it's coming down, trickling down to you? It's like, maybe not, right? Like these are the scraps that are being thrown. It's you talk about Blackstone. Blackstone knows how to underwrite deals. They know how to underwrite their debt and their real estate and their private equity.
Yeah, they have tenure. They have,
they've been doing this since they were incepted, right? And so it's like, you can't assume that everything that's sent to you is the best. There's another one, I think it's Fundrise. Fundrise is coming out with a private equity, and they're advertising it as like, this is your ability to get access to all these. And I'm like, this is going to be terrible because you're getting the scraps. You don't want to do that. You have to invest at the institutional level, and manager selection really, really matters. So my biggest concern with this is that this is going to be junk that's in here. And the industry is excited about it because it's going to be a huge capital influx to their funds, which means more capital to do stuff with.
Yeah.
It's someone to sell to. But like, do you really think that the 401k that's sitting in the private credit fund that's sitting in the Fidelity 401k with access to the trillions of dollars inside of Fidelity 401ks is any good? I mean,
and
that's
expectations
my biggest
too.
concern.
You're private, you're thinking 5x, 10x your money. Doesn't work like that, especially with these funds. So
let's see how this goes. But I just think that likely the funds that are going in there are going to be mediocre at best. And in this private space, manager selection really, really, really matters. This is not buying Vanguard or iShares, and they both do the same thing on the S&P. This is a totally different market. And so we'll see what funds end up in these. It's probably going to be the big players, but
we'll explore this more because I think this is an important consumer protection thing that we should probably be more thorough about.
I agree. Yeah, and then the fund company, the companies getting sued because they're fiduciaries and what the funds go in there. Can you imagine like Microsoft getting sued for putting a fund in there that sucks?
And the
And now
fees.
oh my God. Yeah, the fees. I mean, it's just, anyway, there's a lot to disclose here. And I think that it's more just the industry's trying to scrap for money. All right, let's wrap there. Thanks everybody for tuning in. We will catch you again in a couple of weeks.
Welcome back, Chris.
I've been back for a little bit, but we've been just off the pod. All right, y'all. See you soon.
Bye.